Hi guys, my name is Amor De Libasic. I'm a financial advisor with over a decade's worth of experience. And today I want to teach you how to use and understand leverage. Now, leverage is one of the most powerful tools in your wealth creation arsenal. But for many people, it's poorly understood. And as a consequence of that, it creates a lot of anxiety. Now, leverage is simply the concept that you can utilize borrowed money to augment and force multiply the outcome of your investment or portfolio. So when you borrow money, you're in effect taking a larger position in that investment than you'd be able to if you didn't leverage. I'll give you an example. Let's say I had $100,000 to invest. If that investment returns 10%, my $100,000 has made me $10,000 in return. I have no cost to investment as a consequence of no borrowing, and so that $10,000 is pure profit. Let's say I were to leverage at a 4-to-1 ratio, meaning for every $1 I put in of my own money, I borrowed 4. That means my original $100,000 investment is now $500,000. Assume that my borrowing cost is 5%. That means I now have $500,000 in the market and it's gone up by 10%. That means my return on my investment is $50,000. Now, I've borrowed $400,000 with this investment through my leverage, which means that $400,000 will charge me an interest rate of 5%, $20,000. So my $50,000 return has to be offset by my $20,000 in costs. So my net return after costs are $30,000. Now, my original $10,000 return has now been tripled as a function of the leverage that I've used, which means that my $100,000, if you look at the net return on that with leverage, is 30% as opposed to simply 10%. Now, leverage works both ways. Whilst it can force magnify the outcome if things go up, it also force magnifies the outcome if things go down. So if we use the exact same scenario, if I have $100,000 and I lose 10%, I've only lost $10,000. If I have $100,000 worth of investments and then I leverage 4-to-1, I now have $500,000. If I lose 10% of that, my $100,000 has gone down to 50, and then I have to pay $20,000 in interest costs, which means it's gone down to 30. So leverage is a double-sided sword. It can be beneficial and it can also be expensive. It's important to understand how to use leverage, and the basis of utilizing leverage is basically the following. On average, growth assets go up. So the number of growth years that you have that are positive significantly outweighs the number of years where the market goes down. It's roughly a 4-to-1 ratio if we look at something like the Australian stock market. The degree to which markets go up when they go up is greater than the degree to which markets go down when they go down. This basically means that our positive years, not only are they more numerous, but they're more powerful when they actually occur than the loss years. The third thing is to understand that on average, growth assets outperform the cost of debt, which is to say that if your cost of debt is 5%, the average outcome you might expect from a portfolio of growth assets over a period of 10 years could be something like 10, 11, or 12%. And so the profit that you make on average over time is the discrepancy between your borrowing cost and the return on those growth assets. If we go further down the line into understanding leverage, another powerful force multiplier with leverage is the fact that the gearing that you have, the borrowing cost, is a deductible expense. This forms the cornerstone of negative gearing. Now, a quick refresher, negative gearing is where we basically borrow to invest, and the cost of borrowing that we incur is greater than the income that's generated from that portfolio. So if the cost of borrowing is $30,000, but your property portfolio or your share portfolio is only generating $20,000 a year in income, you've got a $10,000 loss, which can then be offset against your personally earned income. Now, depending on your marginal tax rate, if you're at the top tax rate, that'd be $4,700 coming back on every $10,000 of negative geared returns. The other important thing to understand with leverage is the impact of inflation over time on borrowed funds. Now, most people have a good intuition on the impact of inflation on money that they own. So if you have $1 million and you leave it under the bed for 30 years and you have 3% inflation, most people have quite a good intuition on the way in which that money is decaying, or at least the way in which the purchasing capacity or power of that money is decaying over time. But people don't often bring that same intuition and understanding into the money that they owe. So if you owe $1 million and you have that as an interest only loan for 30 years, at the end of that 30 years, the same level of degradation in the purchasing power or power of that money that would have happened if it's simply cash under the bed also occurs to money that you borrow. So to think about this in the limit, if you would have borrowed $1 100 years ago to buy a property and you had an interest only loan the whole way through, what's the value of that loan now? It's still $1. It hasn't changed whatsoever. But what's the consequence of that loan? Nothing. It's paid off in minutes, if not seconds worth of work. So the consequence of the debt is eroded over time. On average, inflation has a positive, or at least a moderately positive impact on the value of growth assets over time. Now, what I mean by that is growth assets such as shares and property, at least over the medium to long term, tend to align and adjust with inflation. You can do the thought experiment, if inflation impacts the price of a can of Coke, the cost of a can of Coke goes up. Over time, the revenue on Coke goes up, and therefore the earnings per share goes up, and therefore the share price goes up. Whereas your borrowing is not necessarily connected in the same way to what's happening with inflation. And so, on average, what you would expect over the long term is money that you borrow to erode in value over time, the real purchasing power of that money to erode over time. Whereas things that you buy to invest in, if they're quality assets, over time you would expect them to increase in value, actually being pushed up by inflation. And so by borrowing to invest, you create this dichotomy, both where you're winning on the downside and you're winning on the upside of the investment. Now, again, caution. This is true over the long term with averages. Over the short term, it's a messy affair. Things can go up, things can go down. But when you're thinking about the use of leverage, you need a long-term time frame. You need the willingness to take on higher levels of volatility because inflation is a risk increasing tool, which also increases return, and you want to have a steady hand. It does you no good leveraging into an investment only to panic sell when the market goes down because you could really hurt yourself. As always, I hope you enjoyed this video. Please leave us a comment or subscribe or like our channel. It helps us with the algorithm. If you've got any questions or any other topics that you'd like to cover off, please let us know. And as always, have a good day.